Welcome to the video. First, we will introduce why teen driver insurance often exceeds $700 per month and what that number represents. Then, we will show you a step-by-step system to cut costs rapidly without sacrificing essential protection. Stay through the end for practical checklists, diagrams, and 2 quick quizzes to lock in the strategies. Next, here is our roadmap. We will begin with the current pricing reality and risk factors. After that, we will dive into 3 core strategies: adding a young driver to a family policy, optimizing coverage levels, and shopping the market aggressively. Then we will cover the highest impact discounts, test your retention with short quizzes, and finish with key takeaways and an important disclaimer. Now that you know the plan, let's discuss the pricing reality. Teen and novice drivers get quoted high premiums because insurers rely on data indicating elevated claim frequency and severity for new drivers. Limited driving history and credit-based insurance scores can worsen rates. The good news is we can still pull several strong levers to reduce costs significantly. Moving from the overview into specifics, the main drivers of teen premiums include elevated crash frequency among new drivers, rising claim severity given increasing repair and medical costs, and limited predictive data like short driving and credit histories. Additionally, the type and value of the vehicle, plus local regulations, traffic density, and theft patterns, influence pricing. These are the foundational reasons behind $700 plus quotes. With the risk picture clear, let's transition to strategy 1. Joining a family policy. Adding the young driver as an authorized operator on an existing household policy usually lowers the premium versus buying a separate policy. This approach can unlock multi-car and multi-driver discounts and may benefit from the household's stronger tenure, stability, and insurance scores. It also keeps underwriting and billing consolidated. In many cases, this step alone yields the largest immediate price reduction. Next, let's compare a family plan with a separate policy. On a family plan, the young driver benefits from household-level discounts like multi-car and bundling, and the pricing reflects the family's established coverage history. It's typically simpler to manage with a single bill. In contrast, a separate policy isolates the teen's limited history, usually denying access to broader discounts and often producing a substantially higher premium. In most scenarios, the family plan is the more economical choice. Shifting to strategy 2. Optimize coverage. For older, low-value vehicles, full coverage is frequently uneconomical. A practical rule: if the car's actual cash value is less than the sum of your deductible and the annual cost of collision and comprehensive, consider switching to liability only. Maintain robust liability limits to protect assets rather than defaulting to the state minimums. Confirm any licenseholder or lease requirements before removing coverage, and evaluate uninsured or underinsured motorists, plus medical coverages such as personal injury protection or medical payments, according to your state's system. To make the math concrete, consider a sample scenario. A teen's older vehicle has a cash value of about $2,200. Full coverage costs $3,200 per year, with $1,000 collision and $500 comprehensive deductibles. Liability only costs $1,600 per year. If you have no claims, the liability only route halves the annual premium. With a minor collision, full coverage may still not be favorable due to the deductible and potential premium increases, especially given the low vehicle value. Continuing with strategy 3, treat insurance shopping like a process. Start by working with multiple independent brokers who can access many carriers. Then add your own direct online quotes. Ensure every quote uses identical liability limits, deductibles, vehicles, and drivers so comparisons are valid. Ask explicitly about all discounts and telematics or usage-based programs. Reshop at every renewal and after favorable milestones such as turning a certain age, improved grades, or additional accident-free periods. If all quotes remain consistently high, you have likely reached the market floor. Now let's visualize the shopping workflow. The sequence diagram should depict the teen contacting an independent broker, the broker requesting quotes from many carriers, and carriers returning quotes. In parallel, the teen shops several direct insurers. All quotes are consolidated into a spreadsheet and normalized for coverage. The teen negotiates with the top 2 options, selects the best combination of price, coverage, and service, and sets a reminder to reshop in 6 months. Before we quiz you, let's cover high-impact discounts. Good student discounts are common and can be meaningful. Completing accredited driver's education or defensive driving often helps. Telematics, or usage-based programs, can reduce premiums for consistently safe driving, though results vary by behavior. Multi-car and bundling with home or renter's insurance can shave off additional cost. Low mileage or away-at-school discounts may apply, and administrative reductions often come from autopay, paperless billing, or paying in full. Finally, vehicle choice matters. Modest and safe models typically rate better than high-performance cars. Quiz time. Which single move most often produces the largest immediate savings for a teen driver? Option A, buying a separate policy for the teen. Option B, adding the teen to an established family policy. Option C, choosing the sportiest possible car. Option D, filing small claims promptly. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is adding the teen to an established family policy. This option typically captures multi-car and bundling discounts, and it benefits from the household's established coverage history. In most cases, it is significantly cheaper than placing the teen on a separate policy. Second quiz. You drive an older car worth $2,000. Collision and comprehensive together cost $1,100 per year, and your deductible is $1,000. What is the most cost-effective coverage approach? Option A, keep full coverage no matter what. Option B, drop to liability only after confirming no lender requires full coverage. Option C, lower your liability limits to state minimums. Option D, switch to a separate teen policy. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to drop to liability only after confirming no lender requires full coverage. Because the vehicle's value is less than the sum of the deductible and annual cost of physical damage coverage, full coverage is economically inefficient. Maintain adequate liability limits to protect assets. To reinforce coverage optimization, the flowchart should start by checking for any listen or lease, which typically requires maintaining full coverage. If there is no lease, next compare the vehicle's actual cash value with the sum of the deductible and the annual cost of collision and comprehensive. If the value is higher, consider keeping full coverage or increasing deductibles to reduce costs. If the value is lower, move to liability only. Along the way, verify uninsured or underinsured motorists and any mandated medical coverages, and set liability limits at adequate levels rather than defaulting to minimums. This mind map should place teen savings at the center, branching into academic, training, telematics, policy, vehicle, usage, and timing. Academic covers good student documentation. Training includes driver's education and defensive driving certificates. Telematics evaluates behavior like harsh braking and nighttime driving. Policy encompasses multi-car, bundling, paying in full, autopay, and paperless options. Vehicle recommends modest, safe models. Usage captures low mileage and away-at-school qualifications. Timing reminds viewers to reshop every 6 months and check for anniversary-related pricing opportunities. Before we wrap up, let's add a practical documentation tip. Use simple Markdown in your quote spreadsheet notes. Create headings for each carrier, record consistent coverage fields so comparisons remain apples to apples, and add checkboxes for specific follow-ups like confirming telematics terms. Track milestones such as 6 months of clean driving or improved GPA to time your reshops and discount updates. Finally, a brief but important disclaimer. This content is for education only and is not financial, legal, or insurance advice. Insurance laws, discounts, credit-based scoring rules, and required coverages differ by state and by carrier. Always verify specifics with a licensed insurance professional in your jurisdiction and review your policy documents for exact terms and exclusions. To summarize the most important points, add the teen to a family policy where possible. For low-value cars, consider liability only while maintaining strong liability limits. Shop relentlessly using both brokers and direct carriers while keeping coverage terms identical. Stack the highest impact discounts, and reshop at renewal and after milestones to locate the market floor. As we wrap up, remember that understanding the reasons behind the high rates helps you target the most effective levers. Start with the family policy approach for quick savings. Optimize coverage for older cars, keeping liability protection strong. Shop broadly, compare precisely, and revisit your quotes frequently. Finally, use telematics and legitimate discounts to ratchet your premiums down further. Thanks for watching. If this helped you cut your premium, please like the video, share it with someone getting their license, and subscribe for more money-saving walkthroughs. Drop your current rate and your best discount wins in the comments so others can learn from your experience. See you next time.